Hey, hello, everyone. I wanted to welcome everybody participating in today's webinar, the Nonprofit Board Members Essential Guide to Financial Statement Analysis and the Audit. My name is Kim Erb, and I am an Audit Associate at GRF CPAs and Advisors, formerly Gelman, Rosenberg, and Friedman, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what you will need to do in order to earn CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically following the webinar. You will be asked to recall these words in order to receive credit. Please write down the CPE words when they are given and keep them until you receive your certificate, as they will not be provided again. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. The slide deck and recording from today's webinar will be available for download at the link shown here. You will also receive a follow-up email with direct links. Technical support and CPE questions may be addressed to Dominic Acosta at dacosta@grfcpa.com. Today's learning objective is to provide attendees with a better understanding of how to read and interpret nonprofit financial statements, as well as the audit process. One CPE credit is available for this webinar. I would like now to introduce your presenters for today's webinar. Walt Derengowski is an audit partner with over 17 years of public accounting experience with GRF CPAs and Advisors, servicing the nonprofit sector exclusively. He manages audits for a wide variety of nonprofit clients, such as trade associations, charitable organizations, non-governmental organizations, private foundations, political action committees, and other similar institutions. Mr. Derengowski oversees the training and mentoring programs within the firm's audit practice. He also serves as Finance Committee Chair at Young Playwrights Theater. Omid Mehebi is an audit supervisor with GRF CPAs and Advisors. He joined the firm in 2011 and specializes in audits of nonprofit organizations, including foundations, associations, and other charitable institutions, and audits of employee benefit plans as well. Mr. Mehebi has presented to clients and other industry members on the latest nonprofit accounting standards and serves as chair of the Finance Committee of the Homeless Children's Playtime Project, a nonprofit organization in Washington, D.C. I will now turn the presentation over to Walt.
Thank you, Kim, for the introduction, and thank you everyone for attending today's webinar. Omid and I are so pleased to discuss today's topic with you. At the end of the webinar, if we do not get to all your questions, please don't hesitate to contact us, Omid and myself, offline. Now let's get started. Board members have many roles and are entrusted with many responsibilities. They have an obligation to act in the best interest of the company, and at no point should there be any personal benefit or gain. Essentially, it is the role of the board of directors to hire the CEO of the business and assess the overall direction and strategy of the organization. In addition, board of directors are responsible for establishing the organization's mission and purpose, organization planning and monitoring and management financial resources, evaluating the CEO's performance and reviewing and improving the CEO's expenses for reasonableness, reviewing and improving the budgets, recruiting new members, fundraising, spreading the word about the organization, and lastly, understanding the fundamentals of the organization's financial statements and audit process. As you can see, board of directors have many, many responsibilities. And one thing they could do to lessen the load of these responsibilities, as they do have a fiduciary duty to safeguard the organization through oversight, is to hire an independent auditor. Board of Directors can engage an independent CPA firm to opine on the internal financial statements and perform an attestation service. And in other words, stamp an approval as to whether the organization's financial statements are in conformity with U.S. generally accepted accounting principles. Audits provide a comfort to stakeholders because it allows an independent party to come in and evaluate potential risk and to render an opinion on the accuracy of the internal financial statements of the organization. Stakeholders can be management, board of directors, they could be the CPA firm performing the audit, or even the outsourced accounting firm, and other potential users of the audited financial statements, such as banks, donors, and other funders that would like to see an audited financial statement. One thing to mention here is the auditor works for those charged with governance and is retained by the board of directors and not management. That means if anything was to be found significantly deficient or other improprieties were uncovered by the auditor, it would be reported directly to the board of directors. This is why I highly recommend the board of directors have open communication lines with the auditors at least annually, if not more. The next slide here gives a nice overview of what the auditor's responsibility versus the management's responsibilities are when performing the audit. It is very important that members of the board of directors understand the differences noted in the slide. Management is responsibility of the preparation and fair presentation of the financial statements in accordance with accounting principles generally accepted in the United States of America, and that the design, implementation, and maintenance of internal control relevant to the preparation and fair presentation of financial statements are free from material misstatement, whether due to fraud or error. The auditor's responsibility is in expressing opinion on the financial statements based on the audit. And audits are conducted in accordance with auditing standards generally accepted in the United States. An auditor will design their audit procedures based on the organization's internal control environment and evaluate the appropriateness of accounting policies and reasonableness of significant accounting estimates made by management. One of the most important things to note is an auditor must be perceived as independent in both fact and appearance. We cannot make management decisions. I will repeat that again. We cannot make management decisions. However, we can provide guidance and training that will not impair our independence. Also, there are some restrictions in what other additional services we can perform. For an example, at a 30,000 foot level, we would not be able to set up the organization's chart of accounts or set up the accounting system software for the client. That in theory, we would be auditing our own work and would impair our independence. And if we are not independent, then we cannot render an opinion on the financial statements of the organization. The independent audit report, along with the opinion, is the only report inserted in the audited financial statements that is truly our report. All the footnotes and financial statements are the responsibility of management, as noted in the previous slide. An audit provides the highest level of assurance, but keep in mind, it provides reasonable assurance and not absolute assurance. And based on the auditor's test work, the auditor will render an opinion, and they are listed on the slide. It's the unmodified, qualified, adverse, or disclaimer of opinion. The unmodified opinion is a clean opinion and is something every organization strives to achieve. The other opinions noted would be issued if there was a scope limitation or misleading or inadequate financial disclosures that ultimately could make the financial statements presentation materially misstated. Another could be a significant departure from generally accepted accounting principles, or the auditor was not able to perform test work on a certain component or a certain area of the financial statements, which would impede the auditor from rendering a clean opinion. It really depends on the materiality or severity of non-compliance. And, the auditor will, if there would be a difference of opinion on the audited financial statements, the auditor would reach out to those charged with governance, even prior to disseminating them to have that communication line with the board, that the internal financial statements would have a different opinion than an unmodified opinion. And with that, I will turn it over to Kim for our first CPE question or word to get CPE and our first polling question.
Thank you, Walt. For our first polling question today, our question is, auditors can make management decisions for the client. Answer A is true and answer B is false. Please take a moment now to answer. While participants are submitting their answers, I'll provide the first CPE word for today. The first CPE word is guide. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the first CPE word is guide, spelled G-U-I-D-E. I'll now turn it back over to Walt for discussions on the answer to this polling question.
All right, I'll wait just a little bit until everybody gets their answer in. And the answer is B, false. And it looks like a majority of our attendees got that correct. And with that, I will turn it over to Omid.
Thank you, Walt. Good morning, ladies and gentlemen. It's a pleasure to be with you this morning. I'd like to speak to you now regarding the benefits of having an annual audit. Some of you may already be having an audit done on an annual basis. There may be other organizations who are looking to have their first annual audit performed. Essentially, the annual audit provides an independent audit opinion. And the key word there is, again, independent. And this independent audit opinion will increase the confidence that users of financial statements have in the financial information that you're providing to them. Now, who are these users? Well, there are many, but for example, grantors. If you're a foundation, a 501c3 organization, any grantor giving you a significant amount of funds will want to see your audited financial statements. If you're a membership organization, current members and potential members, future members, will want to see your audited financial statements. They want to know what you're doing with their money and how you are performing. Other users include lenders. If you want to go to the bank and get a line of credit for your organization, the lenders will want to see audited financial statements. And on an ongoing basis, as part of the loan covenants, they will want to see, probably on an annual basis, your audited financials. And there are other users too, suppliers, and the list goes on and on. But the main point here is that without that independent audit opinion, the users will not have as much confidence in the financial information that you're providing to them. And this increased confidence has knock-on effects and ramifications. And these knock-on effects include increased revenue. You're more likely to receive more grants if you're a foundation, increased membership revenue if you're a 501c6. It also elevates your status in your industry against your competitors and increases your competitiveness. The other benefit of an annual audit, which Walt touched on, is that as part of the audit, the auditors will provide information about any material weaknesses identified or any significant deficiencies. Now, we will speak a little bit more about the exact definition of these terms later on. But in addition, the auditors will be able to provide best practice recommendation to do with internal controls or operational improvements. Overall, the audit is an investment in your entity and an investment which will pay dividends over a significant amount of time, and those dividends will far, far outweigh the cost of having that audit performed. Now, how do you select the correct auditor for your organization? Again, it could be that you're going out to have your first audit performed, or it could be that you already have an auditor and perhaps you're looking to switch to a new auditor. Well, there are some key evaluation criteria that you need to take into account, both as part of including in your request for proposal, your RFP, which goes out to the market, and also when you get the responses back from your RFP, you want to be able to evaluate each individually. Some of the key items that you should consider are for the following. First and foremost, you want to make sure that the CPA firm responding to your request for proposal has substantial and relevant nonprofit audit experience. So the key word there is nonprofit, not just audit experience, but nonprofit experience. But you also want to make sure that the firm has nonprofit experience and recent experience of nonprofits of a similar size and nature to your organization. So if you are a membership organization and you see that this particular audit firm, CPA firm, has significant experience in auditing foundations, but very little in auditing membership organizations, then that's clearly not going to be of much use to you, and vice versa. Now, in addition to looking at the firm's overall experience, you also want to make sure that the individual team members that are being proposed to work on your audit engagement also have the experience that is required. So it may be that the firm has the experience as a whole, but the individual team members may not have the correct experience of working on entities of a similar size and nature to your organization. Of course, you want to get some information about the proposed fees, both as on an hourly basis and overall. You want to make sure you get a representative client list. And you want to make sure, again, that that representative client list includes names that you recognize and entities that are of a similar size and nature to you and perhaps operate in your industry or similar industries. Make sure you get some references, at least 3 references, contact details for 3 individuals that you can contact directly to get a good understanding of how this CPA firm has performed in the past. Make sure you ask for details of any citations or reprimands against the firm or any of its employees by any regulatory body, and details of any litigation, either current, past, or pending, again, against the firm or any of the employees. Any firm, any CPA firm that's serious about quality control, the quality of its work that it provides to its clients will have a formally documented written quality control document. So don't be shy and make sure you ask about it and ask for a copy of that document. A mission statement on its own sounds very fancy and nice, but it's not enough. You want to have a written quality control document that spells out the measures that that firm takes to ensure that it provides the highest quality of work and attention to its clients. You want to get a good understanding of what the proposed timeline is for the audit. When do they suggest that they start planning activities for the audit? When do they propose that fieldwork should take place? How long do they expect fieldwork to take place? And what is their estimate for the timeline of the delivery of the key audit deliverables back to you, their client? Make sure you ask about any potential or actual conflicts of interest that may exist. And that may be the case if there is any kind of relationship between a member of that CPA firm and any member of management of your entity or a member of the board of directors of your entity. So it could be that they know each other or they've worked together in the past. Now, just because there is a relationship does not necessarily mean that that audit firm should be precluded from performing an audit. but it's important for you to have all the information that is needed for you to make an independent and make an informed decision to ensure that there is no threat posed to the independence of that auditor. That is very important, because if you go back to what we spoke about, the independent audit opinion, the key word there is independent. If there's a conflict of interest that impairs that independence, then clearly that will affect whether that opinion is viewed as being strictly independent. Now, as a CPA firm, under the industry guidelines, we are required to have periodic peer review reports, peer reviews performed in our firm by other CPA firms. So you should ask about that and make sure you ask for a copy of their most recent peer review report and that there's nothing in there that causes you any concern. Moving on to the next slide, now we're going to just talk at a high level regarding the key components of a nonprofit's financial statements. Now, there are some key differences in terminology between the financial statements of nonprofits and for-profits. First and foremost, as Walt mentioned earlier, the financial statements are management's financial statements, and we as auditors are responsible for providing an opinion on those financial statements based on our audit. In fact, the only section of the audit report that is truly the auditor's work is the audit opinion page, which is entitled Independent Auditor's Report. The main statements that we're going to discuss, first and foremost, statement of financial position. This is essentially the balance sheet for your organization, but in nonprofit accounting, it's referred to as a statement of financial position. And just as in a balance sheet, it has to balance. Now, in for-profit accounting, you have assets, liabilities, and shareholders' equity. Here we have assets, liabilities, and net assets, because of course in nonprofit accounting or nonprofits, we do not have shareholders. Assets include items such as cash, receivables, investments, and prepaid expenses. Liabilities include items such as accounts payable, deferred revenue, accrued expenses, and perhaps a line of credit liability. And then net assets. Net assets can be both with and without donor restrictions. If there are with donor restrictions, these could be restrictions due to purpose restrictions, or they could be restrictions due to the passage of time. But the important thing is that assets will equal liabilities plus net assets. Moving on to the next slide. The statement of activities and change in net assets. This is essentially the income statement for your organization. Again, in nonprofit accounting, it has a slightly different name. And you'll have a section at the top which will spell out the revenue for the organization. Now, if you're a foundation, if you're a 501c3, you will typically see grants and contributions, perhaps some investment income, perhaps special events income. If you are a membership organization, of course, you're going to have membership dues, perhaps some conference registration and other income. Expenses will be divided into program expenses and support services. Under program expenses, the financial statements will show the expenses incurred for each of the programs of the organization. And under support services, typically you will have management in general, which is essentially your administrative expenses, and perhaps fundraising expense if that is applicable. Many membership organizations, for example, will not have fundraising expense. The statement of functional expenses at the bottom of the slide there essentially shows the allocation of each natural expense line item across the entity's programs and support services. Now, what are natural expense line items? Well, for example, salaries and benefits or office expenses. That statement will show not just the total expenses incurred for salaries and benefits, but how that expense is allocated across the programs and support services. Now, under the new accounting standards, there also has to be in the footnotes a declaration by management about the methodology that it used to allocate those expenses. So it could be that certain items are allocated based on estimated time spent or actual time spent. It could be based on square footage, or it could be some other reasonable basis. The statement of cash flows essentially takes the accrual basis of accounting and converts it to a cash basis of accounting. And there are three sections that are notable here, which are cash provided or used by operating activities, investing activities, and financing activities. And just to give a few examples, operating activities would include items such as adjustments for changes in receivables and payables. These are the receivables and payables that appear on your statement of financial position. Here, it will show the change between the years. Investing activities would include items such as the purchases or sales of investments and fixed assets during the year under audit. And finally, the financing section would include items such as cash provided from the drawdown of debt or cash used by the repayment of debt. The statement takes the beginning balance of cash at the beginning of the year, adds the change in cash for the year, and derives the ending cash balance. And that ending cash balance will tie to the cash and cash equivalents on the statement of financial position. So you'll see that these statements are all very closely bound together, and they're all interdependent, and everything ties nicely together. So there is a real relationship there between each individual statement. Now, the notes to the financial statements are part of the financial statements, and they provide additional information to the users that we talked about, to the users of financial statements, about the numbers that appear on the main financial statements. Now, depending on the nature of activities of each entity, the notes will differ, but almost always you will see a note regarding the summary of significant accounting policies and general information. And this gives information about the basis of accounting used and other general information. But if applicable, you could have other footnotes. For example, if the entity has investments, there will be a footnote which will provide details of the composition of those investments, whether they are actively traded and how they are measured. For example, does the entity have money market funds or mutual funds or stocks and equities and so on and so forth? Again, additional information for users. Lease commitments. If the nonprofit has operating leases, for example, an office lease or equipment leases, users of financial statements will want to know what are the key terms and provisions of these leases? When do they commence? When do they expire? And what are the future commitments by which the entity is bound by over the next 5 years and thereafter? Retirement plans. Most nonprofits have some kind of retirement plan. It could be a 401k or 403b or some other form of retirement plan. Again, information needs to be given in the footnotes about the key provisions of these retirement plans. What are the eligibility criteria for employees? What are the matching provisions? And what was the employer's contribution expense for the year? Now, we spoke about net assets with donor restrictions before, and in the footnotes, there will be additional information on the breakdown of the final balances. So of the final net assets balance, net assets with donor restrictions balance at the end of the year, how is that broken down into different purpose restrictions, different programs, and perhaps items that are restricted by time? Now, during the year under audit, there may have been net assets which are released from with donor restrictions to without donor restrictions, either because of the satisfaction of those purpose restrictions, because of expenses incurred, or because of the passage of time. The footnotes will give additional information about the composition of that release. Liquidity and availability is a new footnote which is required under one of the latest accounting standards. We'll talk a little bit more about that later, but essentially it gives additional information about the financial assets that the organization has to meet general expenditures within the next 12 months from the date of the statement of financial position. We spoke a little bit about related parties. We touched on that before, but again, users of financial statements will want to know if there are any related parties that they should be aware of. It could be that a member of management or a board of directors of the nonprofit also serves on the board or member of management of another entity with which the nonprofit has some kind of transaction. Again, there should be details of what the nature of the relationship is, what kind of transactions took place, what amounts were transferred between the entities during the year under audit, and what were the amounts due to or due from between the entities as of year end. All of these are very important matters that should be communicated in management's footnotes. And finally, again, this is not a definitive list, but just a representative list, but you will always have some kind of footnote about subsequent events. Now, if there are none, that management deems are material enough to be brought to the attention of users, that's fine. But there may be occasions when something has occurred after the date of the statement of financial position date, which management feels needs to be disclosed to users and say, look, fine, this is a year that was audited, but something happened after the fact that we believe you should be aware of. Now with that, I'm going to hand it to Kim, who's going to provide you with the polling question number 2.
Thank you, Omid. For our second polling question today, how often should board members have open communications with the auditors at a minimum? Answer A, annually. Answer B, quarterly. Answer C, monthly. Or answer D, never. Please take a moment now to answer. While participants are submitting their answers, I'll provide the second CPE word for today. The second CPE word is audit. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the second CPE word for today is audit, spelled A-U-D-I-T. And now I'll pass it back over to Omid for a discussion on the answer for this polling question.
Thank you, Kim. Just give everyone a few more seconds to get your answers in. And as you see, the results show 79% went for annually, which is the correct answer. The correct answer is annually, and looks like the majority of our attendees got that correct. And with that, I'm going to hand it back to Walt. Thank you.
Thank you, Omid. Now I will briefly discuss the audit process. And after the board of directors or the audit committee, which is a subset of the board of directors, has approved the auditors, the first 2 documents that will be addressed to the board of directors are the engagement letter and the AUC 260 governance planning communication letter. Both these documents will communicate and articulate the scope of work the auditor will be performing. It will include the fees. Sometimes it will include in the engagement letter the timeline of when the deliverables will be delivered to management, or even when the audit will need to be concluded and finalized. It also articulates management's responsibility in the engagement letter. And the engagement letter is a contract between the auditor and those charged with governance. And it's required under the audit gap to have an engagement letter. So it is a necessary requirement to have a signed engagement letter. The board of directors will review, and someone will be designated on the board to sign the engagement letter. Usually it could be the treasurer or the audit committee chair, but there are many times where management will sign the letter on behalf of the board of directors. Additionally, I highly recommend a preliminary discussion happen with the board of directors or even the audit committee and the auditors go through the letters with those charged with governance. This will also allow the board of directors to open the communication lines with the auditors and further allow, direct communication with the auditors. This could be done with management on the phone, but I find it's good to have an executive session without management included on the discussion. This allows the board of directors to give any concerns that they have and maybe provide some guidance to the auditors on what things they want them to look at as they're starting to look at the risk assessment and audit sampling. It's really good to have communication lines with the auditors. After the engagement letter has been signed, then the auditor will start providing a listing of items, an audit package that they will need prepared by management prior on audit fieldwork commences. The scheduling of on-site fieldwork is mutually agreed upon between management and the auditors, and the importance of management providing the reconciliations prior to fieldwork is to ensure the efficiency of the audit process. If management is still preparing reconciliations as the auditors are on site, there's going to be inefficiencies with the audit process. That's why it's very important to have a mutually agreed upon date and that all the items are done prior to field work commencing. This again will ensure an efficient audit. And if the auditors are not getting the schedules that they need to complete the on-site fieldwork, then there will be delays in the audit process. Fieldwork can be anywhere from a couple of days to several weeks. It really depends on the size of the organization. The auditor work will include selecting samples of transactions based on the auditor's risk assessment approach and materiality threshold, and incorporating sampling techniques to examine the corroborating documentation, making sure that the organization is in compliance with their internal financial policies and procedures manual. After the auditor is done with on-site fieldwork and they have received all independent confirmation letters, then the audit reports will be provided to management normally 2 to 3 weeks after on-site fieldwork. Again, timing of the audit process really is predicated on management moving us through the process and providing all the documents we have previously requested in the audit package. After management has reviewed and approved the reports, then they are circulated to the board members. And the board members should have ample time to review the deliverables presented by the audit reports. And there's 3 deliverables normally presented. And then at that time, once they have digested the information, the auditor should present the audit deliverables to the board of directors, in which time they will unanimously approve prior to finalizing. But I highly recommend that the audit present to the board of directors because it will answer, or they will be able to answer any questions that the board of directors may not understand. Again, opening the communication lines between those charged with governance and the auditors. Another deliverable, besides the audited financial statements that will be circulated, is the AUC 260 letter. This letter communicates the responsibilities, again, of the auditor in relation to the financial statement audit and provides an overview of the scope and timing of the audit. Again, the letter also reiterates what is management's responsibility. And this letter will, indicate if there were any issues encountered with management and the auditor, any disagreements with management on how to handle an accounting procedure, if there are any significant audit misstatements or past audit entries, irrespective of the materiality. This would be inserted in this letter for full communication and transparency. This letter would also indicate, of course, that the audit firm are independent. That will need to be noted in this letter. Again, if the auditor is not independent, they would not be able to render an opinion on the audited financial statements. The last deliverable, and in my opinion, I believe is the most important deliverable the auditor prepares for the board to review, and that is the AUC 265 letter. This letter is the auditor's communication based on internal control related matters. The audited financial statements are just as equally important, but in theory, the board and the audit committee should already know what the internal numbers are of the organization, unless there were significant audit entries proposed during the audit process. And depending on the severity and materiality of the adjustments, these could be potentially reported in this letter. This letter will disclose any internal control deficiencies encountered during the audit process, and the structure of the letter is separated between material weaknesses and significant deficiencies. And by definition, a significant deficiency is less severe, or a material weakness, is a deficiency or a combination of deficiencies and internal controls that there is a reasonable possibility that a material misstatement of financial statements will not be prevented or detected and corrected on a timely basis. And a significant deficiency is less severe than a material weakness. The auditor's professional judgment will distinguish what is considered a material weakness versus significant deficiency. One thing I recommend is that all organizations insert management responses or a corrective action plan with the auditor's comments. This will provide the board or the audit committee management perspective and when they plan to rectify the matter going forward. And with that, I will open it up to our next CPE word and the last polling question. Okay, Kim.
Thank you, Walt. Okay, for our last polling question of the day, it is, what are benefits of an annual audit? Answer A, potential to elevate status and competitiveness. Answer B, informs of any significant deficiencies and/or weaknesses. Answer C, increases confidence in financial information. Or answer D, all of the above. Please take a moment now to answer our final polling question. While participants are submitting their answers, I'll provide the final CPE word for today. The final CPE word is goal. If you want to receive CPE credit, please jot these words down because you will need them for a survey following the webinar. Again, the final CPE word for today is goal, spelled G-O-A-L. I'll now turn it back over to Walt for a discussion on the answer for our final polling question.
Thank you, Kim. And let's just take a couple seconds here. And the answer is D, all of the above. And it looks like everyone got that answer correct. And I will transition it over to Omid.
Thank you, Walt. I'd like to speak to you now regarding some fundamental performance indicators that you can look for in your audited financial statements. First and foremost, on your statement of activities and change in net assets, you want to be able to look at the change in net assets figure in the without donor restrictions column. And this is essentially the operating surplus or deficit for your organization for the year under audit, an extremely important measure. And also look at the year-end ending net asset amount for net assets without donor restrictions. Again, you want to get a very good idea of how much net assets your organizations has at the end of the year, which is not restricted in any way. One of the measures that we are now looking at as a result of the latest accounting standard is liquidity and availability. And essentially what this is that it's a disclosure regarding the amount of financial assets that the nonprofit has to meet general expenditures within a year from the date of the statement of financial position. So it's really a liquidity measure, both in quantitative terms and qualitative terms. Now, what are the financial assets? Well, cash and cash equivalents, current investments, and current receivables. You'll see that we refer to the term current because we're interested in 12 months from the statement of financial position date, not anything occurring after that. So we add those items together, get a subtotal, and we subtract anything which we feel should be subtracted because of any kind of restriction. So donor restricted funds and board designated funds. That gives us a subtotal. We then take the annual expenses for the organization, calculate an average monthly amount, and divide that into that financial asset subtotal. And that will give us an estimate for the number of months of general operating expenditures that are covered by those financial assets. So it's a measure of liquidity of the organization. Now, there's also qualitative discussion that you will typically see in the footnote. And that will give additional information to say that, look, this organization also has, for example, a line of credit that can be drawn on if there are cash needs, or even the board designated net assets. If need be, those could be liquidated to provide additional cash to the organization. But that's a very important measure, and it's now required to be disclosed in the footnotes by management. The next ratio is the restricted net assets ratio. Essentially, what we're looking at here is the organization using cash and resources now, which are really intended for future purposes, either because they're restricted for future purposes or because they've been received as part of deferred revenue. So this is revenue which is not being recognized yet. So really, it's all about cash, which is for the future purposes. The numerator, add restricted net assets and deferred revenue. The denominator, cash and cash equivalents. Now you want that ratio to be less than 1. If the ratio is greater than 1, essentially what it's saying to you is that the cash and cash equivalents that the organization has is really meant for future purposes. And if it's being spent now, the organization is borrowing from the future. The next measure is the expense efficiency ratio. What we do here is to take each expense line item on the statement of activity, so program services, M&G, management in general, and fundraising if applicable, and calculate those as a percentage of total expenses. And this gives an indication of the efficiency of the organization. If that program expense percentage is high, it means the organization is spending a high percentage of its money on program activities. If it's low, it means it's being inefficient. And if you're a grantor, you're more likely to give money to an organization which is spending 80 cents out of the dollar on program activities than one which is spending only 50 cents out of every dollar, with the other 50 cents going to support activities such as admin. Revenue dependency. Again, look at each line item on the statement of activities and say, as a percentage of total revenue, how much does each represent? So foundations would have, let's say, grants or contributions and investment income and so on. And membership organizations, of course, mainly membership dues and perhaps conference registration. This is particularly relevant where an organization such as a 501c3 foundation is getting most of its funds from 1 or 2 grantors. So the question then becomes, if the relationship with these grantors came to an end, what's going to happen? Is the organization going to be able to sustain operations? Net assets compositions, we already spoke about. You want to look at the percentage of total net assets that are with and without donor restrictions, and ideally you want to have the majority of them to be without donor restrictions. And you also want to see how do these ratios and indicators change over time. So ideally a 5-year period looking back to see how they have improved or worsened over time. Other indicators that you can perhaps look for are current and non-current receivables. Current receivables are receivables that are expected to come in within 12 months after the statement of financial position date. And the allowance for doubtful accounts is an estimate that management comes up with to say that of the receivables that we are booking, we expect certain amounts to be doubtful. It's not to say that we definitely don't expect them to come in, but there is a possibility that they may not come in. They're doubtful, and therefore on the statement of financial position, the receivables are expressed on a net basis after the allowance has been taken into account. Restricted cash and investments, there could be a significant amount of investments on the statement of financial position, but if most of it is part of an endowment where it's part of the corpus of the endowment, which the donor has said cannot be spent at any time, well, that's something that needs to be disclosed and you need to be aware of. Board designated assets we spoke about, whether the board has set aside any funds for an operating reserve or perhaps some future maintenance. Contributed services. There should be, if there are significant contributed services such as contributed consulting services or pro bono legal services, that's something that you should be aware of in your organization. UBIT, unrelated business income tax, as a result of the tax law that came into effect from 1st of January 2018. Many nonprofits that were not previously subject to UBIT are now having to pay tax on employee transportation benefits. So if that's material, it will certainly be disclosed, the amount will be disclosed, but that's something you should be aware of, whether your nonprofit is subject to that tax provision. And investments and fair value hierarchy we spoke about before in terms of the components of investments and whether they are actively traded. Audit findings. as Walt said, you get that letter with findings. There could be material weaknesses or significant deficiencies or other best practice recommendations. How do you develop an action plan? Well, the important thing to realize is that you need to have some kind of management response in writing. Just saying that we're going to get this fixed may mean that it never gets done. Put it in writing, have a plan, break it into steps, have assigned responsibilities to members of management and perhaps even board members about who's going to do what, and have a timeline, a completion timeline for each step. That certainly helps to get the matter resolved. And of course, the auditors are always there to help clarify what their concern was. And at GRF CPAs, we're always here to give excellent personal attention to our clients. Finally, I'd like to go over the key takeaways from today's webinar. We spoke about the benefits of having an annual audit, increased competitiveness, and increased revenue. We talked about the criteria you should use to select the correct auditor for your organization, that you want to make sure that it's a good fit. We talked about the key components of financial statements and the general audit process, and the roles and responsibilities of the board, members of management, and the CPA audit firm throughout the audit process. We also touched on the fundamental performance indicators that you can look for in your audited financials to give you a very good understanding of how your organization is performing and perform some kind of financial analysis, preferably over a few years, to see how things are improving or perhaps even worsening. And finally, we spoke about developing an action plan internally to deal with and resolve audit findings. Thank you, ladies and gentlemen. And with that, I'm going to hand it back to Kim.
All right, so it looks like we have some time now for some questions at the end of the webinar. Walt, I think this would be a good question for you. How can an auditor and the audit work they perform help evaluate the executive director and the finance team?
Well, thank you, Kim. That's a good question. Well, with the audit and based on the findings or comments that they have cited is one good indicator that could determine the competency and the level of their finance team. If the auditor's coming in and there's significant entries that had to be proposed, things like bank recs are not properly reconciled, that's going to be a correlation of is the finance team doing their job, or are they understanding what is required of them? Because in theory, the auditor shouldn't be coming in and making significant entries because the internal financial statements that are disseminated to the board or the audit committee are not accurate. The board is getting inaccurate information, and when the auditors are coming in there and recording entries and that are going to change the picture of the financial statements, that's one thing that will evaluate the finance team. As for the executive director, the finance team works, for the executive director. The executive director should be, reviewing a lot of the work and that the finance team is doing. There should be checks and balances in place. But if the organization over years is not performing and the change in net assets is negative, where the organization is not making income, that is going to be cited in probably a housekeeping comment to the board of directors, that the organization cannot have a net income or a positive change in net assets, and that's a direct reflection of the executive director. The executive director, it says a nonprofit shouldn't make income. Well, that's not true. A nonprofit is going to have to make income to sustain operations prospectively. So, if the organization, 2, 3, 4 years straight have losses, well, that's a direct effect on the executive director not being able to fundraise and bring money in. And now all the things that I just previously mentioned is how the work of an auditor can help perform and evaluate the executive director and the finance team. Thank you.
All right, thank you, Walt. Another question we have here today might be good for me to answer. How do you feel your work as the chair of the finance committee of a nonprofit helps you in your nonprofit audit work?
Well, great question. Thank you, Kim. Well, first and foremost, let me say that we spoke about conflicts of interest. So obviously, the nonprofits that Walt and I serve on as chair of the finance committee, we do not audit those nonprofits, and our firm does not audit those nonprofits because that would be inappropriate. But just to go back to the question, well, I think serving as on the board as a whole, and specifically as chair of the finance committee of a nonprofit, gives us a very good understanding of seeing things from a different perspective, from the other side of the fence, and getting a very good understanding of the financial managements internally of a nonprofit and the issues that arise almost on a daily basis. And that certainly helps us in auditing our clients, because not only are we executing our audit skills, but we have this knowledge about the challenges and the issues that they face, and perhaps that helps us in giving that advice about operational improvements and best practice recommendations to help them improve matters over time. So it's definitely nice to have that kind of 360 perspective, 360-degree perspective, and serving on the board and in the finance committee.
Thank you, Omid. Thank you, Walt, as well. And with that, I think we're just about out of time for today. If you have any additional questions after today's program, please reach out to us. We would love to hear from you. Our contact information also appears here on the screen. With that, we would like to thank everyone for attending today's webinar. We encourage you to follow us on social media at GRF CPAs and visit our website at www.grfcpa.com for any upcoming events and alerts. Please remember to complete the emailed survey that follows if you would like to earn CPE credit for attending today's webinar. Thank you again for attending and have a great rest of your day.